Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. This big fund in China, the largest ever semiconductor fund, which is meant to boost development of the chip industry. This one is being referred to as Big Fund 3, and it totals $47 billion, a little more than that. Joining us now for some discussion is Vlad Savov, Bloomberg Tech editor. So first, let's talk, Vlad, about where this money comes from.
Well, it's the Chinese government itself. There's state-owned banks, state-affiliated banks, and other ventures. Shanghai, Beijing authorities are also putting money in. Bear in mind that Shanghai authorities and Shenzhen ones, they've already invested in the local companies. There's a lot more willingness in China for national authorities to put investment into promising companies, especially in the tech sphere.
So we understand the broad theme here of supporting the semiconductor industry. We know that the challenges that China faces. Do we know much about the specifics of what this money will be spent on?
Well, at the moment, no, but that's pretty reasonable. It is, as you say, $47.5 billion. This isn't something that's going to be spent overnight. It's a multi-year plan. When you look at the previous couple of big funds, they were much smaller. That speaks to the level of investment that's also necessary with semiconductors nowadays, but also those funds ran over the course of several years. So, I mean, you can guess, right? You can guess that it's going to be about AI specifically. AI is the predominant theme across tech and across business nowadays, and it's going to be about chip development, especially because China cannot access US chips for AI.
One wonders whether or not it's targeted at research and development, or whether it might be subsidies for some of the existing companies like Semiconductor Manufacturing International or Hua Hong Semiconductor. And I suppose it's just $47 billion is a lot of money. It can be spread right across the board, can't it?
Absolutely. It's worth bearing in mind, though, that at the moment, the companies that make the greatest headway are the ones that are not spreading the money. When you look at TSMC, it spends upwards of $30 billion a year on CapEx. Samsung, likewise. So it doesn't actually make that much sense to spread it that widely. And when you look at China specifically, Huawei has kind of become quietly China's chip making and specifically chip development champion nowadays. So you can look for Huawei to get a good chunk of the benefit from this.
And might we expect some punitive measures by China against foreign producers, or is it just too tricky? They want to get as much product as they can from outside China. How do you weigh up those two if you're Chinese policymakers?
Right. I mean, all indications out of the Chinese government have been that they're positive, if anything, toward collaboration with international partners. We just had the trilateral meeting between South Korea, Japan, and China, and they were talking specifically about this. They were talking to Samsung and its leader, J.Y. Lee, and they were talking about mutually beneficial relationship and wanting to encourage and to facilitate more investment from the likes of Samsung in the country. And that also reminds me, one of the areas of AI chip development that is subject to the most hot competition right now is HBM, high bandwidth memory, which is where Samsung is trying to catch up with compatriot SK Hynix. And that's one of the areas we saw one of the Chinese news outlets mention that HBM is going to be an area of investment for this Big Fund 3 for domestic HBM development.
Does Huawei make those types of memory chips?
No, Huawei is not ultra powerful and omnipotent. The one thing Huawei has achieved is it has developed its own advanced smartphone processor without the use of any US technology. That's a big achievement, but Huawei doesn't really have the pedigree of developing memory technology. You'll be looking at the likes of YMTC, CXMT in China.
Tell us a little bit more about what Huawei did in building a 7-nanometer chip that sort of spooked U.S. regulators.
That's right. Well, the thing with smartphone processors is they've kind of leveled off. So having a 7 nanometer chip is not the latest. It's maybe a couple of generations behind the latest and most advanced, but you don't really notice the difference. And the real thing that Huawei achieved with the Mate 60 Pro last year is to deliver a 5G smartphone with the battery life, the smoothness of performance, and everything else that you get from any other smartphone. And that was something that US sanctions on Huawei specifically were supposed to prevent.
I hate to put you on the spot, but I think for a lot of listeners, they're not so familiar with a lot of these Chinese chip makers. I mentioned Huawei earlier, and we also mentioned SMIC and also Huahong Semiconductor. For these three companies in particular, and any other names you'd like to drop, let us know what they're quite good at. I mean, what their specialities are.
Well, let's focus on AI again, because that really is the competition that everybody wants to win. In China, there's a couple of names. More Threads is one Beijing-based company, and another one is Biren Technology. Both of them, along with Huawei, are subject to US trade restrictions. And Biren is an amusing case because a couple of years ago, they advertised on their website that their AI accelerators were supposedly better than NVIDIA's. And shortly thereafter, they got sanctioned by the US. So it's a very tricky thing for these companies, because the more that they market themselves, the more that they put forward that their technology is great or competitive with the US, the more likely they are to get sanctions.
Yeah. All right, Vlad, thanks very much. Just a mention to our audience that these companies, many of them sanctioned, so we don't really talk about their share prices and any of that activity. But Vlad, thanks so much for shedding some light on this. A big fund, the Big Fund 3, $47 billion. Vlad Savov, Bloomberg Tech editor. Our guest is Rachana Mehta, co-head regional fixed income at Maybank Asset Management. Rachana, thanks very much for coming in and talking to us here on the show. So I'm curious about your overall market views. It seems like we could be getting close to a kind of cresting or peaking of the U.S. dollar, and one would think that might usher in some opportunities here in fixed income in Asia if currencies then are well supported. What are you looking at?
Yeah, absolutely. I feel that at least one thing clear is we know that higher for longer rates are there. So we don't expect any rate hikes going forward. Yes, rate cuts maybe are pushed down. So definitely we've seen over the last couple of days, actually dollar tries to rally, but then it comes and sells off despite the geopolitics between US and China, and US put some tariffs on China. So we believe that it's almost kind of peaking dollar over the next 3-4 months before just the election risk comes into picture. So at least we know that hopefully the rates are not going higher anymore. Of course, there are no rate cuts. So from that perspective, I think people are looking at peaking in dollars. So we continue to like Asian local currency bonds like India and Indonesian rupiah, which offers an attractive carry, and the currencies, yes, they weaken substantially, but I think now they are pretty stable. And if we believe the dollar is peaking, it's a good time to go long Indian rupee bonds and idea government bonds.
It seems like you're reasonably positive on taking on risk because you like short-dated high yield in Asia.
Absolutely, because of course the spreads are all-time tight. I've never seen such kind of spreads. But if you look at the absolute level of yield, it's pretty high, correct? If you look at 2 years back, the absolute level of yield for high yield was 5%. Today, the absolute level of yield in high yield is about 7.5%. So it's all because of US Treasury, which have sold off so much. So for us, even if, say, just hypothetically Fed hikes 100 basis point, your carry is about say 6%. So even if Fed hikes 100 basis point in terms of duration, if you are holding a 5-year duration, you lose 5%, but you are making 6% on your carry for 1 year. So as long as you're willing to hold for 1 year, you'll still be positive, unlike 2 years back where your yield was only 5%. So I think from a high yield perspective, the absolute level of yield looks attractive, though the spreads are all-time tight.
So even if one is reasonably positive, as you say, it's prudent to have some hedges in place. And particularly, I would think that you might still have to be thinking about the possibility of some sort of hard landing coming next year, right? Or perhaps early 2026?
Yes, absolutely. Because I feel that the longer the Fed continues to keep the rates higher for longer, I feel the underlying US economy is slowing down. I know the employment numbers are holding well, but if you look at retail sales recently in the US, even the PMI, the consumer confidence is slowing down. And depending on the election outcome, with the higher fiscal deficit, higher even interest costs, I think at some point US will decide to have to cut rates. So I do feel that underlying economy cannot hold for so long with such high rates. And especially if, say, Trump comes to power and he puts a lot of tariffs on China and other countries, no matter what, at the end of the day, to create slowdown the US economy because everything will become expensive. So I do believe that the higher the rates are for longer, I feel there is a chance that you may face a recession in 2025. So from that perspective, I think buying a tail hedge of like going long treasury duration on 10 years for 2025, I think it's an attractive idea.
One of the things you mentioned was that you like investment grade bonds in the Middle East. We don't talk on this show as much about the Middle East because our focus is Asia. But if you could take a minute, just tell us what you like there.
Yeah, actually, if you look at the Middle East, correct, despite whatever is, especially in GCC, the Gulf Cooperation Council, like Saudi Arabia, Qatar, Abu Dhabi, they've all been upgraded. So if you look at the sovereign rating, it's very similar. Most of them are now, US is AA plus. All these countries are AA. So recently, Saudi Arabia got upgraded to AA minus. Qatar got upgraded. Abu Dhabi. So against US treasuries, you're at least getting 50 to 60 basis point spread. So I think from that perspective, forget about sovereigns, even quasi-sovereigns, which are same rating as sovereigns in the Middle East space, are yielding you 70 to 80 basis point above treasury. So we believe that those are attractive. And I think Middle East is going through a big sea change. There's a lot of, I think the growth is taking place. They're giving golden visas. They've introduced VAT. So the dependence on oil is slowly coming off. So I feel that over the next 10 years, that will be a growth economy like what was Asia in 1990s. So personally, I'm very, very bullish in the GCC countries, in the Middle East, including Saudi Arabia and Qatar. I think they offer a lot of alpha from an IG perspective names, and given their solid ratings and a tremendous amount of reserves.
Okay. You mentioned earlier if the dollar were to weaken, you like the Indonesian rupiah among a few other currencies in Asia. What would be another one, perhaps, that looks pretty solid and in 30 seconds or so?
Yeah, Indian rupee. I think I know everybody likes Indian rupee, but I'm hoping the the outcome will be out on 4th of June. Everybody's expecting Modi to win. Maybe he may not win with an absolute majority, which a lot of people are talking about. But I think from a long-term fundamental perspective, as long as the election goes okay and more BJP comes to power, I think that will be an attractive risk-reward to go long with Indian rupee.
Okay, Rachana, thank you so much for joining us. Rachana Mehta, their co-head, regional fixed income at Maybank Asset Management. Let's turn to Mary Nicola, Bloomberg M-LIV strategist. Reasonably positive look to things this morning. Although with U.S. valuations reasonably high, you wonder what the catalyst to the upside might be. Whereas in terms of on the downside, there's a number of catalysts that are out there. Some of which we just discussed in our A block with wars and such. Your take on a Tuesday morning, looking at the markets?
Yeah, you might get a little bit of a pullback, especially because we don't have any real big major earnings companies coming through or earnings outlooks coming through. And of course now, especially with a lot of the beats that we've seen from NVIDIA and some of the big, the Magnificent Seven, you could see that expectations are going to continue to rise. So every time you're going to have this bigger hurdle to get markets excited. So I think in the meantime, you get a little bit of a pullback, especially if we see some hawkish rhetoric from the Fed.
We did get the comments from the ECB's Francois Villeroy de Galhau about how the ECB might cut in June and July, and that seemed to lift European markets. Little of those gains were around 0.5% or so. Is that something that investors may target Europe?
Absolutely, especially because if we're seeing some signs of improvement on the economic front, so you're getting an improvement on economic front and then you're getting some looser monetary policy, that's a really good mixture for positive growth and for better growth momentum in the Eurozone if you have that combination. So if in fact they do follow through and we get cuts in June and July, it gives the European markets a bit more momentum. However, the key thing here is that Lagarde has always emphasized about how the trajectory after June has been a bit unclear. And so I think the June meeting will be quite crucial in terms of outlining where we go. And of course, every CPI number will be absolutely critical in terms of guiding the ECB on its trajectory.
And if the ECB is cutting, whether it's once or twice or even more, before the Fed gets moving, you would think that the dollar would strengthen against the euro, and that might not bode too well for other countries' currencies.
Yeah, absolutely. So you'll get a boost of the dollar as a result of the euro, and then you see the dollar strength being even more amplified. And if you get dollar strength more amplified, obviously the regional currencies in this part of the world are going to be very much affected, especially since their rates are so low.
That said, this morning it looks like Hong Kong and China stocks might outperform, and it's a little curious because although we did see another move on the property front with Shanghai cutting down payment ratios and lowering the minimum mortgage threshold for buyers, we have seen actually a little cooling in the activity of developers in the Hong Kong market of late, pulling back around 10 or 12% from a pretty sharp rally before. How's it looking on that front?
Yeah, there's been a lot of positive momentum for China and Hong Kong stocks, largely from what is coming out of the rhetoric from policymakers. And that should continue to help. It was interesting to see that the markets shrugged off some of the G7 communique that came through in terms of highlighting about trade tensions. And that was really maybe compensated by the fact that the policymakers seem more committed to growth and to that 5% target and to really re-energizing and managing the risks in the economy. And that should help boost sentiment overall.
And are we still at reasonably low valuations for Hong Kong and China stocks vis-a-vis other markets?
We are, yeah. So if we compare it to a lot of the regional markets, whether it's Korea, Taiwan, India, we're still pretty inexpensive valuations for China and Hong Kong.
So let's go back to one of the big drivers, Wall Street. You mentioned that you could see a little pullback in the short term. One of the issues will be what we get on the inflation front this week, and maybe what we hear from Fed speakers like John Williams and Lisa Cook and Neil Kashkari and Lori Logan. They'll be speaking this week. So there's something to sink your teeth into. In terms of the inflation numbers, it does seem that the PCE numbers are expected to be fairly moderate this week. Tell us what you think the impact might be with those numbers coming.
Yeah, Bloomberg Economics made a good point in saying that there could be a moderation, but the moderation is actually due to something as volatile airfares. So that doesn't tell you that the underlying is actually making progress. And we've heard from the likes of Christopher Waller, who said that he would need at least 3 more pretty good CPI numbers to come through to get more convinced. Because last time he rated the most recent CPI numbers as a C+. It's passing, but it's hardly passing. So I think you'll still need to see some further progress on the inflation front, and especially the core stuff. Anything from the underlying core inflation, some of the sticky components. If they're showing some progress and some headway, then the Fed can gain further confidence. But if you have a lot of these volatile underlying factors that are contributing to the deceleration, that really doesn't help the Fed.
With earnings pretty strong, Mary, if you get inflation kind of muddling through, which is not particularly good news, but it's not significantly bad news, is the market not showing you that it has responded well to the earnings, and it's not really ready to sell off on higher for longer? It might sell off in the face of of higher interest rates, full stop. But since we're not getting that, the market can make its way forward. That seems to be kind of the thinking. Does that not resonate with you?
It does, but in many other ways, the fact that earnings still has to outperform and all the expectations continue to run high and are going to continue to run high because the fact is we're beating them. So any sort of shortcoming on earnings is going to have a real drag, especially because you don't have that momentum from the Fed supporting you and you do have rates higher for longer. We know from the Fed that the next move is likely to be a cut, but we know that it's not going to be a hike. So that's one thing that's keeping the markets afloat. But at the same time, if earnings don't continuously beat and show that they're going to continue to outperform, that's going to weigh on sentiment, especially when you have some of the key activity indicators showing a slowdown in the economy.
What are we seeing from earnings that should be part of this broadening out story? Because, it's tempting to say that if you don't want so much exposure to NVIDIA and Broadcom and AMD and some of these, that you can buy into some of the other areas that are also benefiting from second, third, and fourth derivative plays on AI. But are we seeing it in the earnings?
Earnings have come up quite considerably, especially even if you take X Magnificent 7. So they have come up, they have come off from their lows. So that's been a positive momentum as well. There has been some discussion over, should we look at value versus growth as well? And so there's still opportunity out there. It's just a matter of obviously choosing the right time and looking at where the earnings are going to continue to perform. And of course, AI seems to be the focus right now, but there are pockets, especially if you look at S&P X Magnificent 7, that are showing that earnings are in fact improving.
All right, Mary, thanks very much. I wanted to spend just a moment talking about this chip fund, so we'll let you go, and we'll talk again soon. Mary Nicola there, Bloomberg M-LIV strategist. This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.